Well, good afternoon. Global stocks slipped to an almost two-year low as investors brace for the key U.S. inflation data later, likely to shape the size of the Federal Reserve's next interest rate hike. There was little sign of respite in either Asia or Europe, and a seemingly unstoppable dollar holding its ground in the currency markets. Bond traders are also watching Britain's bond market, with the Bank of England due to end its emergency stabilization measures. Meanwhile, newly released minutes from the Federal Reserve's September meeting showing that officials were committed to raising interest rates to a restrictive level in the near term and holding them there. To talk to us about all of that and also throw forward to that US CPI figure, we are joined by Patrick Matidi from Aluwani Capital. Patrick, thank you so much for your time. In this environment where we're dealing with depressed bond yields as well as a hawkish Fed rhetoric, and then you add in the uncertainty around the Bank of England's next move, how's our JSE holding up?
Good afternoon, Natasha, and thanks for having me. We started off very nervously, watching obviously the much anticipated US CPI number that will come out later today. So at this point, we're slowly drifting into negative territory. We've done about 0.4%. Not clear trends yet. I think it's probably the quiet before the storm. So once that number comes out, I think then we'll see which way the markets go. But you are right, as per your intro, the markets have been very nervous the last few weeks, and we are trading at low levels we have not seen in the past 2 years.
Any company news that caught your attention?
I think the gold stocks are trading deep into negative territory compared to the rest of the sectors. And I think it is on the back of the Fed comments with regards to the minutes, where they are committed to keeping rates as high as need be, to actually try and quell inflation. And we do know that gold price itself and also the stocks, they don't respond well in a high rate environment, largely because gold does not yield. You don't get any interest or any income from gold. So the holding cost of gold actually goes up when rates go up, and that is not good for the metal, and that's not good also for the companies. And this is despite a very weak rand, where that ordinarily would have been supportive of the gold companies and other resources. But in this environment, I think the bigger concern is around interest rates going forward.
The one thing that caught my attention was the IMF's report, and especially the warnings in terms of what we can expect. And the chief economist saying that we have to batten down the hedges and that worse is still to come. In the fight for inflation, do we then inherently assume a recession is around the corner?
I think it's almost inevitable, especially when you read the Fed minutes, where they appear a lot less concerned around the impact of the rate hikes on the broader economy with regards to recession, but fixated with the fight against inflation. And I think it's right, it's correct for them to be fighting inflation because inflation actually undermines confidence, takes away the power of capital. And if that comes through at some cost and the growth in the economy, I suppose so be it, because they are also limited in terms of tools available to them. But I think, the bigger concern, though, if you look at other parts of the globe, is I think recession we can kind of live with, but stagflation is even worse. So stagflation is zero or low growth with very, very high inflation, which implies still a lot more rate hikes to come. And I think this is what the European or the Eurozone is facing at this point in time, especially when you look at that Germany CPI number that came out earlier this morning.
On that note, then, are you start seeing signs of cracks, given that we've been talking about if you push too hard, things are going to break?
Yeah, I think that the next in a few months or so, we'll have to look at the data sets to see, the impact of the recent rate hikes on the real economy. So there are still some signs which we just scratch through, especially on the corporate side. So what you would call, sort of the high yield part of the financial markets, these would be companies that, during very low interest rate environment, went and borrowed, quite hard. We're seeing a lot of those starting to wobble to the extent that, the amount of debt on the balance sheet, the cost of servicing that debt is becoming a lot more prohibitive, especially in an environment where growth is also slowing down. So I think we'll see that playing out initially in the corporate space before the broader and global economies.
U.S. earnings season kicks off tomorrow, starting us off with the banks. What are you going to be looking out for, not just for the banks, but overall the season?
I think this season or this time around, we are likely to see a lot more, corporates expressing a level of uncertainty, looking forward, especially with regards to the impact of the rate hikes on their businesses, but also, the expected, slowdown in the global economy and the impact of those onto their customers. So I'm not expecting, very, very, sort of upbeat outlook and sort of expectations, but I think the numbers, to the end of September can still be supportive looking backwards, but I think looking forward, there should be a lot more uncertainty and a lot more headwinds that the companies are starting to report.
We are expecting that US CPI figure later on. What is the market expectation, and what happens if it just means, the Fed is definitely going another 75 basis points?
The market is expecting 8.1 year-on-year growth in CPI. This is against 8.3, which was reported in August. You'll recall that the peak was around 9%. So we are coming lower, but I think the trick is, the actual number needs to come in a lot lower than expected. If that were to play out, anything below 8.1, I think the market will collectively, sort of express a sigh of relief. But if it comes out a lot worse than that, then I think you should see another sell-off coming through. So if it comes in within expectation, you could therefore see the Fed maybe in the next meeting in November actually hiking by 50 basis points, because by then they would have had some comfort that, in fact, the medicine is starting to address the problem, which means that the prior rate hikes may be starting to have an impact on inflation, and therefore going forward, they may not need to be as aggressive because even though their mandate is inflation, they also have a secondary mandate, which is growth. So they are sort of balancing inflation and the impact of high inflation, of high interest rates on the real economy or growth. And so they may therefore need to temper down their rate hikes. But certainly, if that number comes out a lot higher than expected, then another 75 basis points will be priced in, and it will almost be taken as a given when they meet again in November.
Patrick, let's leave it there. Thank you so much for your time. That is Patrick Matidi from Aluwane Capital, giving us his perspective on the market.